Hello and welcome back to Core Finance. I'm Matt Brown, and it gives me great pleasure to introduce back onto the show Chris Justin from 7IM. How are you today, Chris?
Very well, Matt. How are you?
Very well. Well, thank you very much for coming in. Look, we're in September. We've got through the summer, and actually it wasn't a bad summer. We didn't have any kind of Greek debt crisis.
The weather could have been better, couldn't it?
Yeah. Very true. Obviously a bit of kind of North Korea geopolitical things to move the market at least, but we didn't see huge amounts of volatility.
Yep.
But now here we are in September, a few months still to go in 2017. Equity markets overall have performed very well.
They have.
But in the latter part of the year, where do you see these markets going?
I think it's the million-dollar question, because at the moment, if you extrapolate forward what's going on in the bond markets, I think that looking at the yields at the moment and the fact that it would indicate that interest rates aren't going anywhere at all, and I think bonds, and developed market bonds in particular, will be looking quite expensive. I think in contrast, though, if you look at equity markets and what's going on at the moment with central bankers, they would seem to indicate that there are going to be rate rises on the horizon. So if we look at what's going on with the ECB, I think the next step many people are expecting from Mario Draghi is both to stop what he's doing or reduce what he's doing from a bond buying point of view. We didn't see many indications of that at the last speech we saw a week or so ago from him, enough to move the market slightly, but slightly more dovish than was expected. Janet Yellen's obviously made a couple of rate rises, and we've also got the UK. A couple of months back we had the 5-3 football score interest rate decision from the Monetary Policy Committee. So they would seem to contrast with one another, because one's saying we're almost expecting interest rates not to go anywhere, and therefore bond yields are going to basically remain where they are, and the other would indicate, and equity markets will also seem to support, that the economy is more resilient maybe than many people would be agreeing with, certainly from a bond point of view, and therefore they're seemingly at loggerheads. Now, if we look and we say that the bond market might be correct, and let's just say that interest rates aren't going to be going anywhere, or let's say Janet Yellen completely pulls the rug out from under everybody's feet and was to reduce interest rates out of the blue before the end of the year, then equity markets are going to be affected, arguably quite dramatically, particularly where we look at where the VIX has been and we look at the volatility that's seemingly been absent really this year. If conversely we think that equity markets might well be correct, then the bond markets might end up struggling, because it would indicate that the economy is slightly more resilient than many people are giving it credit for in the fixed income space. It would indicate that the earnings that have come through and some of the valuations have been justified, and a lot of the data that we've seen, which seemingly is quite robust from a global growth point of view, and we're looking at GDP and a lot of the hard data, then bond markets might well therefore be affected, because we're going to be looking at a steepening trajectory of interest rate rises. So the difference between the two has to be reconciled at some point, but seemingly, despite the fact that they're not agreeing, everybody seems to think that we're going to continue off in this nirvana at the moment, this benign environment. I think the third factor that many people aren't really talking about, despite the fact that it's front page news, are things that aren't really market related. First being the geopolitical tensions that you mentioned. I mean, firing a warhead over Japan, where North Korea is concerned, was enough only to move the S&P down by about 1%, and it regained that within a day or so, which is quite bizarre when you consider that only back in 2015, a seemingly slowing down of investment in China was enough to send the markets into a tailspin for a couple of months. Even if we use that example as well, private investment in China is starting to slow down, and yet the markets don't seem to be taking too much notice of that either. So if you look at geopolitical tensions, if you look at what's going on with Mr. Trump, and generally speaking, if you look at valuations and how narrow the leadership there's been, I think the S&P is up about 10% so far this year, and of that 10%, 30% of those gains the S&P have been from Microsoft, Amazon, Alphabet and Apple. Now, just imagine yesterday if Apple, I don't know if you saw the update, that had stopped at that iPhone 8, and everybody was so disappointed. It's always fascinating to follow Twitter on these things, because you get everybody's instant reaction. They're all spitting the dummy out, all these avid followers of Apple. Yes. And if the iPhone 8 had been the stopping point and there wasn't and another thing, what would that have done to Apple's share price? And therefore, if they're able to, because there's such a high component of the indices in the US, drive the market that far forward, it can easily unwind the other way. So our concerns would be, these geopolitical tensions, the narrow market leadership, and generally speaking, that if you had a period of low volatility for such a long period of time, there's an element of complacency there. If 2007, 2008 has taught us anything, it's the fact that when volatility levels are consistently low and that people have stepped into an element of complacency, then that is the time to be worried.
And from a portfolio management point of view, when you're looking at bond yields being so low,
Yeah.
equities potentially overvalued, where are investors, or as a portfolio manager, where are you looking to invest? I mean, if you're underweight bonds and equities,
Yeah.
you're basically sitting on cash, and there's obviously no interest being paid on that.
Yeah.
So how does a portfolio manager or an investor, one of our
Yeah.
viewers, play this market?
Well, it's a really difficult one because traditionally, when people do look at asset classes, you're right, they'll think, I've got my equities, or if I don't like equities, I'll shift into bonds. And traditionally, you'd look at UK govies, you'd look at treasuries, and you would say bunds, and you go, brilliant. I know that I don't like equities, therefore, because there's a divergence in the way they perform, I'd expect that to be my downside protection, I'd expect that to do well. There's been a real correlation between the two of them, and as I mentioned earlier, the fact that the differences between the two aren't being reconciled means that they're having to look elsewhere. So if we're not liking equities, we're not liking bonds, the alternative space, which really is a title for anything that isn't equities and bonds and cash. Commodities, gold, as we know, has had a great run. I think it's delivered about 5% in the last quarter, up above $1,300 an ounce. I think infrastructure is an interesting one. And generally, if you have the expertise, or you're able to access the expertise where you're able to do things like trade some of the constraints that you've got on the market, or inflation protection certificates, different things that are, some of them may be directional and linked to what's going on with equities or with bonds, but they're doing something slightly different away from that space. Because from our point of view, we're willing to forego some of the potential further upside where bonds are concerned, because we think when interest rates do go up, and we do think they're going to go up eventually, people are going to get hurt in that space, and that's where you're going to see a lot of the headlines. And we're happy to lag behind where some of the equity upside might be, because we think there are too many unknowns on the horizon. So the alternative space in particular is a space that we're interested in. From a bond point of view, treasuries, I suppose, is the area from a risk-off perspective.
And you mentioned the likes of certainly the US, the tech stocks outperforming.
Yeah.
Is it a case now of maybe trimming, if you have a diversified portfolio with US equities, maybe trimming back some of those tech stocks, maybe looking at more defensive stocks, so the utilities, just to tweak the portfolio in a sense that you're still in the market, you're still benefiting from some performance, but if it does downturn, you've got a little bit of protection there.
That's right. You can look at it in two ways. I think the first one is from an equity allocation point of view, you can look at other geographic areas. Europe's an interesting one still for us. Japan, you've got consumer sentiment is up. Some lack of confidence in Abe in some respects, but inflation is low but steady. So that's not a bad place from our point of view to be at the moment. Europe, after lagging behind for the Anglo-Saxon, if you like, economies for a period of time, seems to be doing okay. We've had that push forward after Macron got in, slightly worn off now, but it would seem like they're coming back in towards normality. And the emerging markets as well. Always can be, I suppose, an area that you've got to be a little bit cautious in, because if the US sneezes, then everybody ends up catching a cold, and you tend to see people rush out of emerging markets. But when you look at some of the valuations, they're trading at many, many multiples below their equivalents elsewhere in the world. So I think the first point would be different geographic areas from an equity. But if you look and you like the US and you still have conviction that's an area to be in, I think looking at the sectors quite closely you're in is prudent, because as you said, the tech stocks have been on an absolute tear, and you do have to question how much further that can go.
Understood. Well, Chris, thank you very much for joining us today.
Thanks for having me, Matt.
Hopefully have you back on the show very shortly.